Hi, welcome back to our channel. This is Daming's Analytics channel, and basically our primary goal is to make learning available to everyone that is willing to learn. So usually we post very interesting videos which you can actually learn from, such as posting data science project, data analysis project. So this actually will help you a lot because it doesn't matter the number of certificates or courses that you've done, but the employers really want to know what you've been able to achieve with the knowledge that you've acquired. So subscribing to this channel is going to help you a lot so that each time we upload new videos, new projects, so you'll be aware and also be able to carry it along and also practice one or two stuffs. This importantly will help you to improve your knowledge of what you have actually learned. So we encourage you to like the video, subscribe, and share the video to your colleagues that might also benefit from it. So in this video, we are going to be working on a data analysis project, and this project is very good because if you are a data analyst in a company, so this is one of the, probably you are working with a group of company or people that are into trading or investment and stuff like that. So you're going to be dealing with a lot of risk analysis. They're going to be asking you for they're going to be asking you for analysis of data in order for them to have some insight. So in this project, we're going to be working on financial risk analysis using Python. So I'm going to be analyzing Apple and S&P 500 stock market data. So this is the scenario. Okay, so this is actually a risk scenario, and I got it from a practical experience that we had with our client. So let's say we have ABC company and they are about to buy shares in Apple and S&P, so with the target to obtain optimum profit in the space of 2 years. Okay, but now they are curious to know how the two companies, that is Apple and S&P, have been performing for the past 3 years. So knowing this will actually help them to have a better understanding. Have these companies been performing well? Are there potential of we achieving our aim of profit? So now the manager approaches you as the data analyst in the ABC company. So, and his question was, please, can we know how the Apple and S&P 500 stock market have been for the past 3 years? So, and he added, we would like to know if the risk is minimal or unaffordable for us. This is actually a risk scenario. This is a situation that we have handled in Daming's Analytics, but with different data, of course. So now this is what we are going to be handling in this project. So as a data analyst, we will answer these questions in different ways by analyzing data and giving them insight from the data. So we'll be using Python, and in Python we can use libraries such as pandas for data manipulations, yfinance, where if you don't have a yfinance package already installed on your computer, you will need to install them. So if you are using Anaconda, just type Anaconda yfinance, and also you will need a PyFolio, so for performance analysis. So just install them. I believe you know how to do that. If you don't, just check on Google. So you will have to install those, and then because we'll be using yfinance to fetch the historical stock prices data and also matplotlib for visualization. Then for more advanced financial analysis, we can use NumPy and also PyFolio for performance analysis. So make sure to install these packages if you haven't already. So let's install the package. Let's import the packages. So pandas, finance, matplotlib, NumPy, and PyFolio. And let's run it. So the next step right now is to get the historical stock prices And how do we do that? First and foremost, you will need symbol for the symbol for Apple. So, and their symbol is actually AAPL. Then the next thing now is to indicate the start date. From when to when? The start date is equals to, let's say, since it's a 3 years data, right? So that will be from 2020 January 01. Then end date. The end date will be yeah, let's say from up to 2023. Then 12/31. Then the next thing now is to fetch the data using yfinance. So yf.download. Download the data. Then we insert this parameter symbol. Then start is equal to start date. Then end is equal to excuse me, end is equal to end date. End date. So now let's download and see. Cool. So the data is downloaded 100%. So the next thing right now is to calculate the daily returns. Let's see what we have in our data .add. Yeah, cool. So this is what we have in the data. We have dates, we have open, high, low, close, and the likes. So now the next thing now is to calculate daily returns. So which is an important parameter when you are performing financial risk analysis of stock data. So data, let's have another column called returns to the data. So this will be, we'll actually calculate this on the agent close. Then we're going to call PCT change function. PCT change function. So this is the function that we use to calculate returns on a stock market data.add. Let's see what we have. Cool. So we have an additional column called returns. So this is how to calculate returns in Pifolio, using Pifolio. Then the next thing now is to calculate volatility. Volatility. How do we calculate volatility? Volatility is equals to, volatility is simply standard deviation. So it's just the rate at which things changes over time. So let's use numpy.std. Then volatility of the returns. Let's see. So let's see what we have. Volatility. Okay, so this is the value for the volatility. We're going to be interpreting later under the insight derivation. So just follow as we are calculating these parameters, because these are the parameters that you need to interpret how Apple and S&P 500 have been doing for the past 3 years. So the next thing now is to calculate beta. Beta is another parameter that we use in financial data. So and we're going to need additional data for that, which will be the data from S&P. So we're going to calculate that as well. That will be market data yf dot download. Then you have to indicate their symbol. Their symbol is, if I remember vividly, I think GSPC. Yeah, GSPC. Let's see if we are wrong. He's gonna call us back. So start, then start date, from start date, then end is equal to end date. So there's a magic we normally do in data manipulation. We call joining, data joining. So we're going to join this this data with the Apple data so that we'll be able to, since we're using the same date. So we just join data.join, data.join, then the market data, join the market data, only the adjoint clause, because that is the only column that we need, the only data we need. So then on what we want to join them on the data in the index, use the same index, since we use the same date, start date, end date, the same data. So just join them on that. Then for us to be able to differentiate, let's add the suffix, additional argument, so that it will just add adjoint clause, then market. You will see what I'm actually saying after we've gotten the data. So the next thing now is to calculate the returns for the markets. Returns, then for the market data, then this will be on the adjoint clause column market. So like I said earlier, we calculate returns by using PCT change function from Pyfolio. So let's check the data and see what we have. Invalid syntax. Where is the problem? GSPC. Yeah, so it has actually downloaded the data. So we just input the symbol, the start and the end dates. So those are the parameters you only need to download the data. So, and this is the data that we have already downloaded. So we have the returns market, we have the close market. So the data are actually okay, and now we can move forward. So which is calculating beta. So to calculate beta, we need the covariance matrix first and foremost. So the covariance matrix is equals to numpy dot covariance cov. Then inside this we have to supply the returns data. So in case of some issues, let's just drop the none, because of course we have some non data there. So let's drop them. Then inside this we also indicate the returns for the market, because we want to know the covariance of the two. Returns market, then also drop the now value to prevent some issues. Then, so our beta now, our beta parameter will be curve matrix. Then inside this we have to specify the parameter is 0,1, then divided by the curve matrix. So I believe you have some at least fundamental knowledge of some key financial risk parameters and how they are being calculated. So there is nothing magic here. So beta, now let's see what we have. So the value is 1.189 blah 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 blah. So we are going to be interpreting later, as I said. So the next thing now to calculate is the sharpe ratio. Sharpe ratio data is calculated using also the returns data, then taking the mean, value divided by the volatility, So the sharpe ratio now, let's see what we have, is about 0.05. Okay, so now we are moving to the visualization of the data. So where we are going to be visualizing the daily, weekly, and monthly returns of this company and see visually how they are performing. I mean, for the space of 3 years backward. So let's say data is equal to weekly returns. Then this will be on the data. Weekly returns dot rolling. We're going to be using the moving average. So I have already created a video on how to do moving average in Python. So if you have not watched that video, you really need to know how to do moving average, because as a data analyst, you're going to be using that very often. So dot mean, so that is take the mean of the returns per week. Then another one now will be for the monthly, or month returns is equal to, it's almost the same thing. So I'm just going to copy. So then put 30 here, average from 30 days. So let's see what we have in the data now. So now we have additional data, which are a monthly, weekly returns, monthly returns. So the next thing right now is to do some kind of visualization of the data. So let's visualize. See what we have. So we're going to be visualizing the data to see, be plotting both the daily returns, which is daily returns, the first one, Then this weekly returns, if you like, you may plot the what is it called? You may plot monthly return as well. So, and the other parameters here are just the visualization parameters. So let's see what we have. Let's see what we have right now. Okay, cool. So this is actually showing us the daily and weekly returns of Apple stock prices. So it's the blue is the daily return, while the red is the weekly returns, and you can see the patterns in the so the next thing right now to visualize is the cumulative returns, which is the most important aspect of this visualization, because with that you're going to be seeing the trend right from January 2020 up to December 2023. So let's see how to do that. So let's see. So we'll actually be plotting both the daily, weekly, and monthly returns, cumulative returns for each of these, and then so this will allow us to see. Oh, nice. So this is the cumulative returns of Apple. The daily, weekly. So daily is in green, weekly is in red, and monthly is in black. So we can see the trend that, at least relatively, we've been having a gradual monotonic increase from January 2020 even up to December 2023. So, but between for the year 2020, they didn't experience such a very good monotonic increase, as we can see that it's relatively flat between 2022 January up to December. So, but from January 2023, they began to increase again. So, by the time we start interpreting the parameters, we will actually get the gist much better. So this is good. We can also, you can drop the monthly. Let's drop the monthly so that the plot can look a little bit much better. Let's drop that. Let's see. Okay, yeah, this is, I prefer this. So this is the weekly and the daily cumulative returns. So actually this is very good, but we are not there yet because we need to calculate more parameters in order for us to explain the result much better to the manager that has actually asked us to analyze data for them. So, and more parameters include VAR, alpha, treynor ratio, and the maximum drawdown. So these are very good parameters for us to have a robust understanding of the stock market behavior of alpha and S&P 500. So I have already written the code here so that the video will not be too long. So I'm trying to prevent that. So how do we calculate VAR? Is just actually a percentile. So on 95%. Significant confidence interval. Then also you calculate alpha using the polyfit. So then the treynor ratio. So if you are actually conversant, if you are actually familiar with these terms, I believe you shouldn't have any problem on how the formulas were actually calculated. So of course you can change some parameters, and feel free to do that so that you will know how the result actually changes. So let's run this and see these parameters, their values, after which we will be interpreting them. So these are long decimal values. So volatility, beta, sharpe ratio, VAR at 95% confidence level, then alpha, treynor ratio, and maximum drawdown. So what exactly is the meaning of how do you interpret this result? This is the most important part of the analysis, because if you copy these results and put them in Excel as a presentation, and you say, oh, okay, volatility is 0.0 this thing, beta is 1. Nobody cares. Nobody cares about that. What they really want from you as a data analyst is the insight. How do you derive insight from this result? So that is what we are going to be doing right now, and I really encourage you to watch to the end. Watch this video to the end so that you can grasp the concept that you need as a data analyst. So the insight derivation part of this project states that, number one, the volatility value up to the 4 decimal places gives 0.0211. And what is volatility? Volatility indicates the degree of variation of a trading price series. Now, a lower volatility suggests a more stable investment. Okay? So, I mean, relatively, or we don't have anything that we are comparing with now. Let's say the volatility is okay, 0.0211. Now, the beta value, which gives 1.1897. Beta value actually reflects the stock sensitivity to market movement. So, now a beta value above 1 suggests that the stock is more volatile than the market. The people that you are talking to, they are already relating with you with these terms that you are using. Now, the sharpe ratio gives 0.0561. So, and it measures the risk-adjusted return. So, a positive sharpe ratio indicates a potentially favorable risk-return profile. So, the VAR at 95% confidence level represents the maximum expected loss with a 95% confidence. So, a negative value suggests a potential loss, emphasizing risk, right? So now the alpha value indicates the excess return over the benchmark. So positive alpha implies this investment outperforms expectations. At least it's positive, right? So now the treynor ratio, which is negative 0.0158. So it measures the excess return per unit of systematic risk. So a negative value may suggest an underperform compared to the market. So we are comparing the Apple against S&P. So the S&P is what is the market, right? So now the maximum drop down of value 0.3143 represents the maximum drop down actually represents the largest peak to peak trough decline in the investment value. So a lower drop down is generally preferred. So this is interesting, but now what advice are you giving to the manager that has actually asked you to analyze data for them? So if, let's assume I am the data analyst now, right? So this is actually what I'm going to be saying to the manager, that now considering the positive sharpe ratio and alpha, which are the main two parameters that show promising risk. So the investment shows potential for positive risk adjusted returns. However, the high volatility, beta and negative treynor ratio indicate higher risk and sensitivity to market movement. So investors, that is the people that the manager will be talking to, should carefully assess their risk tolerance and consider diversification strategies. So not that they will now focus mainly on Apple. It will be better that probably they diversify their investment. So it's crucial to monitor market conditions and stay informed about company development. So it's very important for you to study more in a more deeper sense to know what Apple is actually planning for the next 1 year, for the next 6 months, for the next 2 months, for the next 2 years. What are the things that they have in their plan? Are those things with potential of increasing the profit? So, however, I am a data analyst. I am not a risk analyst. So it will be better that for the investors, that is the people that managers will be talking to, it will be highly recommended to consult a financial advisor for a more personalized assessment based on the company's financial goals and risk tolerance. So now, one may ask me, are there no threshold to consider for these parameters? My response will actually be no and yes. It is no, because the thresholds are functions of several factors such as your risk tolerance, what a company might be able to cope with. I mean, another might not. So, and it's a function of risk. Then investment goals. If you are investing massively, all these small variations in the stock price might not really affect you so much. And also the conditions. Just like when the COVID-19 happened, a lot of stuff happened. A lot of things that people never, predicted happened. So those are the kind of market conditions to consider. Then what I consider to be highly risky might be tolerable for you. So it is yes, because when you compare with other company portfolio, you might be able to draw boundaries. So summary, this project basically analyzed the historical stock price for Apple and the S&P. So using yfinance package. Then we calculated the daily returns and then computed the volatility, beta, sharpe ratio, treynor ratio, and other parameters, another important. Let's assume that we just went ahead and calculated for only sharpe ratio and which other one performed well like that. Yeah, sharpe ratio and alpha. We might have actually concluded that, oh, yes, it's very good. If you invest, you're going to get a lot of money. So, and this and that. Whereas, you did not investigate other parameters. So that is very, very important for you to ensure that you make your analysis as comprehensive, as concise, and precise as possible. So finally, we visualize the daily return, weekly and monthly cumulative returns. So basically, this is what I want to show you in this video. So we've actually gone through the project together. So the best way to learn is by doing. So go through the code, enter them, change some parameters. By this, I'm 100% sure that you will learn better. And also, another assignment that I will encourage you to work on is to check for other companies. Check for other companies or use a larger amount of data, maybe 5 years of data for Apple or other companies. So analyze it and see, learn more. So with that, I'm pretty sure you're going to gain a much deeper understanding on how to do data analysis in a real world scenario. Because if you're a data analyst, you will definitely be in cases like this. You can see that the manager did not actually tell us, do this, do that, do that. No, they would only ask you questions. So responding to that question, it is your job. as a data analyst. Okay, so thank you so much. I really encourage you to subscribe to our channel, like, share, and comment. So let me know what you think, and for sure we'll improve stuffs, and then you will learn much better in the subsequent content. Thank you so much, and see you in the next video.